Good morning, tech traders. Today is the 14th of March, 2023, and we are during market hours here sharing a trade that I'm looking at in IBM. IBM, sure you've all heard of it. It's an old stalwart, very high paying dividend stock. I have owned IBM in the past. I don't own any shares at the moment, but I have traded it very successfully in the past. A lot of people say that IBM is really not a trade-worthy stock because the volatility just isn't there. Historical volatilities are in the 20s, and we tend to look for some things a little bit more volatile than that in terms of getting a trading campaign going. But we are in a very, very edgy market right now. We're just coming off the collapse of Silicon Valley Bank. The financial sectors are really taking some heat, and there's just a lot of edginess in the marketplace. So I tend to like to trade around more stalwart type shares than speculative shares at the moment, particularly when they show opportunity. You'll notice here that we've got a little tick up in volatility with IBM that I picked up on the screens here. And, IBM is typically, as I said, not a hugely volatile stock. It does have periods of volatility coming into the earnings announcements. And you can see that here on the screen in these areas. If we go to a longer time frame chart on this, and let's just go out to maybe 3 years, and we can take a look at some interesting things with IBM. You can see it trades in a pretty steady range here. Not a lot of huge swings, but the thing in here you can see that I was an active trader, successful trade campaigns on IBM in the past. The thing that gives a 5% yield with dividends sort of really helps this thing along in terms of being able to give a good overall yield if there's enough volatility that you can squeeze out some trades on the thing. And so, as I said, I've traded it successfully in the past and would have no issue trading it again in the future. So I was looking at initiating a trade here. Some interesting things to note is where you would want to be a price buyer of IBM. And in the past, you can see that these big shoots here, these big rises in price that you can see where they jump outside of the Garch model. Right here, you can see one where it jumps outside of the Garch model. Here, you can see one that jumps outside. That price buying level is got to be driven by institutional trade. It's not retail trade that drives that type of price buying, and that seems to be a consistent level right here around 115, 120, somewhere in that range. Looks to be a pretty good zone for buying IBM. And I would not disagree with that. If you look at IBM, you can see right now there is some skepticism around the analysts in here. We do have one buy recommendation on it. You can see from the price history, it's traded in the past 5 years as low as 105, but it trades in this range. It's currently trading for about 125. If I look at the Trefis price on this, it's suggesting it's about $145. Valuation on the company. Everybody knows what IBM does. They do carry some debt, but IBM on the list of candidates that could be going bankrupt is got to be pretty low on that list. So I do like the shares, and let's see what we might be able to piece together on IBM. So when I open up our software package here, what's the first thing you notice? The first thing you notice is that we've got a VIX term structure and backwardation. That's the fear in the marketplace, driven largely by the financials. So we do have a term structure and backwardation that is bearish for the stock market. Today is an up day. We've had a bounce back after the Silicon Valley Bank scare, and the government stepped in to shore up some the deposits, and that's creating a little bit. It's taken the edge off the market a little bit, but you can see the VIX is still in I would say, teetering on a borderline fear range. It's over 20. Historical average in VIX is around 20, and it's slightly elevated. And the VVIX, which shot up the other day, is dropped back down with the bullishness in the marketplace today. But we have to be aware of this term structure when we play any long delta position in the marketplace. So let's take a quick look at IBM and see what it's telling us. So if I punch in IBM here, the recent price history comes up, and you can see that we are trading below its 50-day and 200-day moving averages. That is a red flag in terms of the market could be slightly bearish on IBM. So again, we have to watch our deltas on anything that we do. The other thing that's flashing red is the coefficient of variation, which is 24. That just means that this thing has had some pretty big moves in recent times, and it can move. So we have to be aware. Again, when this thing flashes red, I tend, if I'm selling options, which I'm intending on doing here, I tend to get a little bit further outside of the first standard deviation with my trades, just because this is a warning signal that this thing can and has moved significantly in any given time frame. So you can see the volatility, the historic volatility profile of this. Average volatility is in the 20s here, high 20s over a longer period of time. It's actually historically been a little bit flat lately, so it's been a lot lower than that, than its historical volatility. So let's take a look at some trades that might be out in the April time frame. I'm going to choose the 21st of April. On the call side, these trade in $5 widths. On the call side, I'm going to start with something that's at the money, so I'm going to start at 125 and fill those up. And when I see that, you see that when we get up around the 140 level, we start to get a little bit of a warning flag that the markets are widening out, and the liquidity is getting a little bit suspect. You can see that there's still a lot of open interest up here, and these markets aren't all that wide. So I don't consider that to be too terribly much of a negative indicator. But again, we have to keep an eye on how liquid these things are going to be. On the put side, I'm going to start one standard deviation out from where the current price is. So I'm going to start with the 115s, and I'm going to fill those down. So Devos will go out and grab the market right now where we are. These are also starting to flash some red signals here in terms of liquidity. You can see them bouncing back and forth a little bit. These markets are widening out because of that fear in the market, because of the negative or the VIX term structure being in backwardation. You can expect that when fear in the marketplace increases, that you're going to start to get a little bit wider bid-ask spreads because of that fear. So that's something that we need to take into consideration. You can look at the vol surface diagrams here. We are showing a significant put skew on there, which again, the fear is to the downside. We are in a bearish kind of price regime for IBM. Again, take that into consideration. I don't know that I'd want to go with a lot of positive deltas on this trade. So the thing that is most interesting that I think that there is edge in is take a look at where the front month implied volatility is relative to the historical volatility. So we always believe that if there's a good distance between this figure here, this flat line figure here, and the historic volatility, that there could be some edge. There could be some Vega edge in there, some variance premium that we might be able to capitalize here on this. So that lays the scene. Let's see if we can build a trade that makes sense here. I mentioned that buying area, where I think that there's an institutional buying area. You could call it support. It's not really, I don't view it as really technical chart support levels, but it's certainly a buying level that I would be interested in approaching, and that is at the 115 level itself. I would want to be out of this trade somewhere around 2 weeks before expiration. So let's set that in Devos that this is when I would like to be out of this trade. And if I look at the 115s and just simply look at selling those, what is Devos telling me? It's telling me that right now it does have some trade expectancy in there but we are falling short of our payout targets given our probability of profit with the 115s, and we're not making it there either on the expected return on capital or the expected return on risk. So I'm going to go a little further out of the money, which I'd like to do anyway because of that coefficient of variation. So I want to take that down, and let's take it down to a 110 level. Now that's starting to look much better. I've got a good solid probability of profit. I've got a good payout ratio, 123%, so I'm risking 211 to make 62. And the only place that I'm getting a little bit stressed here is on the return on capital. The return on risk looks good, and as does my sizing on this. So that's looking a little bit better. So I like the idea of shorting the 110 puts, but I want to see if I can make this a little bit more efficient with the trade. So I'm going to actually what they call buy a teeny, and by buying a teeny, I'm going to make it a little more capital efficient. You can see here that the capital requirements over here for going that short, that 110 is pretty high. But if I buy myself some real out of the money protection, go out to the 90s and purchase a protection way out here, it's going to be a very wide put spread here. And as you can see, it's running into some difficulty with, again, return on capital and return on risk. The sizing would be about right for that position. But again, I'm not achieving my targets in terms of return. So let me see if I can manipulate this a little bit here. Go back to the 115s. And if I do that, again, no expected value there. So this is turning out to be very difficult to trade. If I bring this down even further to the 105s and the 90s, now that's looking a little bit better. Now if I'm looking at the 105 90s, my cost of capital is much lower. I'm looking at about $1,500 in capital, and I am got a good probability of profit, risking 79 to make 28 here. That's a great payout, almost 200% payout ratio, and a good return on risk, 10% return on risk. Looks very good. The sizing suggestion here is I could take at least 5 of these, or I could take 5 more of these. So I'm going to increase my lot size to 5 here on this spread, on this put spread. And by doing so, now I've got it appropriately sized for my account. I've got a very good probability of profit, almost a 200% payout ratio on this, $140 in credit. And the thing that I'm looking at the most here is, if you look at the Greek sensitivity profile, I've got a good balance between my positive delta. A short put spread is a positive delta position, balanced by a short vega position here. So that ratio between my delta and vega, these ratios here, I like to see this vega to theta ratio below 3, and I like to see this delta to theta ratio below 5 when I initiate the trades. And that gives me a little bit more comfort in that I've got a good balanced trade here. So I'm going to go ahead and put this one on a 5 lot of the 105.90 put spread out in April. Very good trade metrics on the thing. It's sized properly for the account, and that will begin the initiation on IBM. The thing that is important to know, and in any of these trades, is if you're going to trade out here, you always have to have in the back of your mind, am I willing to be an owner of IBM at that level at 105? My answer is a resounding yes. If I look at IBM here historically, and I'm out here at this price level of ownership for IBM down here, 105, 110. I am a very interested owner in IBM. So that I hope will turn out to be a good trade for us. Again, there's a lot of fear in the marketplace, and there's a lot of volatility starting to creep in. So that's going to push me a little bit further out in terms of wanting to have a little bit more safety. So this trade diagram you can see has got the short put spread way here past the first standard deviation. So this trade is setting up nicely. I'm going to put this trade on, and hope you found this helpful. Best of luck in your trading and what's happening in the marketplace. Any questions, you can certainly contact me on the Discord channel. So thanks for tuning in, and best of luck with your trades.